Welcome to U.S. Tax Classroom. Millions of Americans feel the monthly sting of paying off student loans. But here is a silver lining that most taxpayers miss entirely. The interest you are already paying can powerfully reduce your tax bill. And the best part? No itemizing, no complex paperwork, and no high threshold to clear first. It is an above-the-line deduction, which is a huge advantage. But the IRS has layered in strict income limits, specific eligibility rules, and a proportional phase-out calculation that completely trips people up every single year. In this explainer, we're going to look at exactly what qualifies, how much you can legally deduct, who secures the full benefit, who gets a partial benefit, and who gets completely locked out. Here is our roadmap for today's explainer. We'll start with the deduction rules and limits. Then we'll look at qualifying loans and taxpayers. Next, we'll cover the 2025 phase-out income ranges, followed by exactly how to calculate those phase-out reductions. Finally, we'll review Form 1098-E, claiming the deduction, and strategies for stacking your benefits.
Section 1. Deduction Rules and Limits.
Let's establish the foundational rules first. The student loan interest deduction allows you to deduct the lesser of $2,500 or the exact amount of interest you actually paid. That $2,500 is a strict cap per tax return. It's not per loan and it's not per borrower. It is an above-the-line deduction on Schedule 1, lowering your adjusted gross income right away. Remember, only the interest counts, never the principal. But voluntary prepaid interest absolutely does count. Let's build a real example with Leo and Mia. They file married filing jointly. Leo paid $1,500 in interest, Mia paid $2,000. Together they paid $3,500 in student loan interest. But because they file a joint return, that cap strictly limits them. Their allowable deduction stops dead at exactly $2,500. The practical takeaway here? The IRS applies this cap per tax return, totally regardless of how many loans you or your spouse are juggling.
Section 2. Qualifying loans and taxpayers.
Not every loan automatically qualifies for this benefit. The IRS has very deliberate rules you have to pass. First, the loan must be solely for qualified education expenses, like tuition, required fees, room and board, or books. Second, the loan must be legally in the taxpayer's name. And third, the taxpayer cannot be claimed as a dependent. The IRS wants a strict firewall between parent and child obligations. If the loan is in the child's name, parents can't claim it, even if they pay the bill from their own checking account. Conversely, a child can't deduct interest on a Parent Plus loan. The law follows the legal paperwork, not the cash flow. But as long as it was for education, both federal and private loans are perfectly fine.
Let's look at Chloe to see how rigidly this rule is applied. Chloe is a college student with a qualifying loan in her own name. She actually works part-time and makes all her own payments from her own bank account. But because her parents still claim her as a dependent, Chloe is entirely blocked. Her allowable deduction is $0. The practical takeaway is absolute. Dependency strictly overrides who actually pays the bill.
Section 3. 2025 phase-out income ranges.
Now we hit the income limits, where many find their benefits reduced. We need to touch on MAGI, or Modified Adjusted Gross Income. For most of us, it's just your standard adjusted gross income, but technically, the IRS requires adding back certain deductions, like this specific one, to find your MAGI. Thankfully, tax software handles this circular math automatically. For 2025, single filers face a phase-out window beginning at $85,000 of MAGI, eliminating the deduction entirely at $100,000. For married filing jointly, the window begins at $170,000, and it's completely gone at $200,000.
But there is a massive trap here regarding filing status. Let's consider Sam's situation. Sam is legally married, but chooses the married filing separately status. His MAGI is incredibly low, just $60,000. He paid $2,000 in interest, yet his allowable deduction is $0. The vital takeaway here? Using the married filing separately status immediately and entirely disqualifies you, regardless of how little money you make.
Section 4. Calculating phase-out reductions.
What happens if your income lands exactly inside those phase-out windows? The IRS uses a proportional method to slowly chip away your deduction. Here's how the calculation works. First, you find the distance from the bottom of your range up to your MAGI. Second, you divide that distance by the total width of the range to get a percentage. Finally, you multiply that percentage by your interest paid to find out exactly how much of your deduction is phased out.
Let's apply this to a real example with Alex. Alex is a single filer. Her MAGI is $90,000. She paid $2,500 in student loan interest. The distance from the $85,000 bottom of the range up to her $90,000 Magi is $5,000. The total width of the single range is $15,000. We divide $5,000 by $15,000. That equals 33.3%. So 33.3% is phased out. We multiply her $2,500 interest paid by 33.3%. That gives us $833 phased out. We subtract that $833 from her original $2,500. This leaves her with a final allowable deduction of $1,667.
Let's compare two extremes now. First up is James. James is single, with a MAGI of $72,000. He paid $3,000 in interest. Because his MAGI is entirely below the $85,000 start, 0% is phased out. However, the strict cap limits his allowable deduction to $2,500. On the flip side, we have David. David is single with a MAGI of $105,000. He paid $2,500 in interest. Because his income is completely above the $100,000 ceiling, he is 100% phased out. His allowable deduction is 0. Earning just a bit too much completely stripped away his relief.
The exact same proportional math applies to joint returns. Meet Mark and Emily. They file married filing jointly. Their combined Magi is $185,000. They paid $2,000 in interest. Their joint phase-out window is $170,000 to $200,000. Their Magi is exactly $15,000 above the bottom of that window. We divide that $15,000 by the total window width of $30,000. That equals 50%. Their benefit is cut perfectly in half. 50% of the $2,000 they paid is $1,000. This leaves them an allowable deduction of $1,000. The practical takeaway here? Every single extra dollar you earn inside that window chips away at your tax relief.
Section 5. Form 1098-E and how to claim.
How does the IRS actually track all this math? Through Form 1098-E. If you pay $600 or more in student loan interest, your loan servicer is legally required to send you this form. The IRS gets a copy too. Claiming it is incredibly simple. The exact amount goes directly onto line 21 of Schedule 1. Your tax software will automatically handle that proportional phase-out math we just did based on your income. Keep the form in your records for 3 years just in case.
But here is a critical nuance you can't afford to miss. Let's consider Rachel's scenario. Rachel paid exactly $500 in interest. Because she didn't hit the $600 threshold, she got no Form 1098-E. However, she is still fully eligible to claim the deduction. By verifying the $500 paid on her online account, she can enter it onto Schedule 1. Her allowable deduction is $500. The major takeaway is that the $600 rule is simply a reporting threshold for the banks, not an eligibility threshold for you.
Section 6. Stacking deductions and takeaways.
Because this is an above-the-line deduction, you can actually rescue phased-out benefits by stacking other deductions to lower your AGI. For single filers inside the phase-out window, carefully consider this math. For every $1,000 you lower your AGI, maybe through an IRA contribution, you don't just get that initial tax benefit. You also recover $167 of your lost student loan interest deduction. It's an amazing 2-for-1 benefit.
Let's revisit Tyler and Sarah from a previous explainer. Walk through this deliberately with me. Both had incomes inside the single phase-out window. Tyler made a traditional IRA contribution. That single action dropped his Magi below the $85,000 threshold. Doing so magically unlocked his full $2,500 student loan deduction. Sarah chose no contribution. Her income stayed stubbornly stuck right in the phase-out window, and she was forced to settle for a partial, reduced deduction.
Let's methodically summarize today's explainer. The student loan interest deduction offers a $2,500 cap per tax return. It is an above-the-line deduction, so absolutely no itemizing is needed. The loan must be your legal obligation, and you cannot be a dependent. The single phase-out runs strictly from $85,000 to $100,000, and the joint phase-out runs from $170,000 to $200,000. Married filing separately cannot claim it at all, and strategically stacking other deductions can push your Magi down to unlock your full benefit.
The tax code doesn't reward you for what you pay, it rewards you for what you know how to report. Are you accidentally leaving money on the table this year? Really think about that before you finalize your return. This is Video 3 of the 9-part mini-series on above-the-line deductions. Video 1 covered the foundation of what above-the-line deductions are, and Video 2 covered the traditional IRA deduction in full detail. Next up, we will tackle the self-employment tax deduction and self-employed health insurance. Make sure you subscribe to US Tax Classroom so you don't miss it, and check out our shorts for regular tax quiz questions. See you next time.